Hi, welcome to today's show. Listen, we got a power-packed show for you today. We're going to talk about why big losses hurt you, especially when you take an income, and what you can do about it. We're going to talk about two similar portfolios invested exactly the same way, but meet with two different drastic results. And then finally, we're going to talk about standard deviation. That's just one of those financial jargons that we use, but very important for you to understand. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome to Retiring Well. Listen, in this segment, we're going to talk about why big losses hurt. And then most importantly, what are the things you can do to combat it? All right. Well, first of all, let me just give you this scenario. Let's say you have $500,000 sitting in your portfolio. You now want to take 5% for income. Okay, so we're going to pull $25,000 a year off for income. Hopefully it's growing by such so that you can kind of maintain principal and maybe even grow it a little bit over time, right? Sound like a great plan? 2008 comes along, market drops to half its value. Now your $500,000 account is down to $250,000. But what if it is that you still need that $25,000 for income, or that 5%? What's that represent now in the total portfolio? It now represents 10%. How are you going to grow that back? We now have to get consistently a better than 10% return year after year to even get it back, even growing towards where it was before. So you can see why it's so imperative that you have to stay away from those big losses, especially when you're taking income. Now, if you're somebody that doesn't need the income, sure, it'll come back. But it took 5-6 years for it to get back to where it was at before, after we've experienced the last two bear markets. You can avoid it. Here's some things that you might use in approaching this situation. You know, first of all, there's insurance type products. There's also bank products that are safe. They offer downside protection, right? If I'm in a CD, you know, it's FDIC insured, I can't lose. And they're also giving me a guaranteed interest rate. That's a consideration. How about a fixed annuity? This is typically a financial instrument with an insurance company, offers, you know, insurance protection, you know, based on a full faith promise of that insurance company. But you got the downside protection and them also giving you a guaranteed interest rate. How about a fixed indexed annuity? Same thing, offering you downside protection, but tying your interest maybe to the index. These are typically insurance products or bank products designed to give you downside protection. May be consideration when you're looking at your overall portfolio. But what are some other things you can do? Well, one might be, you know, that old adage your grandma told you, don't have all your eggs in one basket, right? Diversify the strategies you're in. Maybe you got those accounts that can be more aggressive, have more volatility associated with them, may go down in value, but if I don't have all my eggs in that basket, then maybe it's not going to hurt as much. Maybe I have a fair amount in other strategies that have maybe downside protection or are less volatile, maybe some in this arena, but when you experience a big market downturn, it's not going to hurt as bad. That might be one way to approach it. Another way to approach it would be what they call a laddered approach. For example, let's say I'm somebody taking income. Let's say I want to take 5% out over the first 5 years. Let's take that 5% times 5, or 25% of my portfolio, set it aside just for that income in the first 5 years in what would be traditionally very safe investments. Take the next 6 to 10 years, have that in another 25%. That now I can put in some instruments that could grow for 5 years and then give me income for another 5 years. And then now the rest of it, or what would be maybe half the portfolio, in traditional growth portfolios. You know, think about it. I don't need it for 10 years because I've set aside my income for 1 to 5, 6 to 10. Now this is what we call the 10 plus years. I can take a little bit more volatility with it because I have time on my hands. So there would be a way to approach it. Another way to approach it would be maybe the bucket approach. You know, maybe I want to segment my money in such a way that I have nothing but what you call income in this bucket. So this is going to be with all financial instruments that allow me to keep it safe for income, designed just solely for my income for the rest of my life. Now, the rest of it can be put into other buckets that serve different purposes. Maybe another bucket that's maybe conservative growth, has some volatility, but it's there for those emergencies and things that I need in maybe the short run. And then the rest of it, if I'm fortunate enough to have enough money because I've satisfied the income bucket, the conservative growth bucket, the rest of it can go in what we call traditional growth buckets. So that if the market takes a big drop, it's not affecting me because I have my income needs already met. Listen, there's a number of ways to approach this. This is why it's so imperative. If you're near retirement or in retirement, you want to call us. You want to see what approach might be more appropriate for you. So I encourage you, give us a call.
Wow, Larry, I think that was a really interesting segment and really a vital one for those folks that are nearing or in retirement. So often, especially in this time period we found ourselves in when the market has been so strong for so long, people forget about volatility. You know, John, I know in a lot of our consultations with folks and meetings we talk through, we have this acronym we use, and it really, I think, is good to just simplify it and help people understand what is out there and talk a little bit about that.
Yeah, we always talk about how much risk can you take, and the C's capacity, A's attitude, N is need, and it's really that need factor. A lot of times when we run scenarios, we're trying to look at, okay, how much money do you have saved for retirement, and what if you only made 3 or 4% a year type of thing, pretty conservative returns, and hey, good news is your money's going to outlive you type of thing. So that money's there for you throughout your lifetime. You can generate a good income. So why do you necessarily need to be taking on as much risk?
Yeah, and John, that's a great point, because if we've sat down and done a plan and we figure we only need them to take 3-4% from the portfolio, then we have to beg the question, why are you swinging for the fences here when really all you need to do is have base hits, right? I mean, that's the key. Now, unfortunately, there's times when somebody does have to take a greater amount out, and maybe we need a little bit more growth in the portfolio, but that's where it falls back to what I was talking about in that earlier segment. Don't have all your eggs in one basket. Right. If you got an additional balanced strategy of stocks and bonds and you're relying on that strategy to totally give you 6-7%, that's great. But what are you going to do when those years come like in 08 and it drops to half its value? You better have a plan in place.
Yeah, and that's where we just encourage you to give us a call. We're more than happy to sit down, no cost, no obligation, second opinion, and we'll just analyze where you're at currently, maybe what risk you are taking on, and maybe really understand that need factor.
Now, guys, in the next segment, I'm going to be talking about 2 similar portfolios with 2 drastically different results, which is going to play into this discussion that we're having. So stay tuned.
Today's retirement challenges can be mastered. Knowledge is power, because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how 2 similar portfolios can end up with 2 drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, August 6th at the Evergreen Resort in Cadillac. Thursday, August 8th at Big Buck Brewery in Gaylord, or Tuesday, August 13th at Stafford's Bayview Inn in Petoskey. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Okay, folks, we're going to have a little fun with this, okay? We're going to have 2 brothers Okay, they're both going to retire with $500,000, $500,000. They're going to take 5% out for income, okay, which would be $25,000 per year. Okay, they're invested exactly the same. Two similar portfolios, no difference. And I'm going to add this. They're in the same tax qualified accounts, meaning the same mix of IRA, the same mix of Roth IRA, and maybe non-retirement money. Okay, they're exactly the same. Now, the two brothers, we got Steve and we got Bill. Steve starts off with his $500,000, takes his 5% out each year for income, and in the next 10 years, his account value ends up being worth $1,377,510. Folks, he just about tripled his money while he comfortably took 5% out each year for income. Now, Bill, his brother, remember, he's retiring at the same age with the same exact portfolio, taking his 5% out each year for income, and at the end of 10 years, his account is worth $205,943. He just about lost 2/3 of his money. Folks, what happened? What happened? Now I'm going to leave this question out for you, right? Think about that. How can we have two drastically different results when they had two similar portfolios? Now I'll have some people jokingly say, well, Bill, who had a drastically bad result, he maybe some catastrophe happened, right? No, they had two similar portfolios. If there was any kind of a catastrophe, it happened to both. All right? Well, maybe Steve won the lotto, right? That had to be what happened. No. We're going to leave that outside, right? Nothing outside of the investments happened. They were both similar, and they both ended up with a different result. What could have possibly happened? You're thinking about this, right? And you're thinking, how? Well, I'm going to show you. This is what happened. Steve retired right here in 1990, and look what he got the next 10 years, between 1990 and 2000. Bill retired in 2000, and look what he got the next 10 years. Folks, the only difference in those two scenarios, those two situations, those two brothers, is simply when they retired. They retired at the same age, but they retired at a different time. Now, think about that. The only difference being when I retired. See, here's the point. Look at this. Between 1960 and 1980, that looks pretty volatile, right? But look at this period. We had 2 decades of unprecedented growth. So what's happening right here in 1980? Companies are getting away from pension plans. It's the beginning of all those contributory plans we know today, like IRAs and 401ks and the like. And what generation is just getting ready to save for retirement? The boomers. And look what we get for the next 20 years. But then what? We get 2000. All right? The tech bubble. Market drops to half its value in a 2.5-year period. And then it no sooner comes back by 2007, and then we get the credit crash of 2008. It drops to half its value again. Had I been somebody like Bill taking income in that period of time, look what the result was. Terrible. Here's the point I want to make here. Here's what you need to see. You look at this period right now. This is a new reality for us. Watching the market have a lot of volatility. If I'm that person trying to take income from a portfolio, I can't have this. I can't have this. Think about it. If I'm taking 5% income from a portfolio, and now that portfolio drops to half its value, well, now that 5% I'm taking is actually 10%. How am I going to grow that back? So stay tuned.
Wow, great information, Larry, on those two similar portfolios, two different results, and ultimately, guys, coming back to just simply a matter of time as far as when they retired was the only difference, Art.
Yeah, and I think it's really important for our listeners out there. I mean, this isn't just a few dollars difference, as you can see in this result. This is a big number. And imagine if you were in that situation in your retirement, and that depended upon that income, that paycheck coming in, and that what was it, over $1 million and then a couple $100,000. I mean, that's significant. Now, what do you think the likelihood of you living? Let's say you're only in your 60s or maybe even early 70s at that point, and now you have to live the rest of your life. You're going to have to make some lifestyle changes, potentially, who knows what healthcare situations and all of that are. So planning, and what better time are we in right now? The market's been strong these last several years now, and concerned folks are kind of starting to lull themselves to sleep in that situation and not be prepared for something like this.
That's right. Listen, another 08's coming. The markets are cyclical. You'll have periods of expansion followed by periods of contraction. It's coming. There's already leading indicators pointing to the fact that the economy is going to be slowing down. But can you imagine being Bill, who retired, and then 10 years later he's at a fifth, he's less than half of what he started with. Do you think psychologically he got back into the market? No. I mean, he's worried about one more bad year coming, and so most people that got hurt in 2000, 2002, or 2008 after some big market decline like that typically didn't get back in, and they never got the growth back. So it's all the more reason why people shouldn't have all their eggs in one basket.
Yeah, and that's why I think, guys, for us at Centennial Wealth Advisory, our focus is, okay, we see that you have enough money. Let's make sure there's a plan that's in place so that you can generate an income stream throughout your retirement and not get to a place. We never want to have that conversation of, hey, sorry, the market didn't cooperate, you have to go back to work, right? So that's where, again, we offer no cost, no obligation, second opinion. We'd love the opportunity just to sit down with you and understand where you're at and what you're trying to accomplish with your retirement.
Yeah. Now, guys, in this next segment, Mike Reese is going to do a chalk talk on what we call standard deviation. And all standard deviation is basically low variance, And again, when we're taking income, we want accounts with low variance. So understanding this is going to be very important. So stay tuned.
Are you drawing closer to retirement or already retired? Do you feel confident that you have a plan in place for your retirement? At Centennial Wealth Advisory, we believe there are a number of areas within your retirement plan that must be working together. It's very important that you have a long-term income plan. You don't want to run out of money in retirement. And we believe that tax planning should go hand in hand with your income planning. So we have our very own accountant on the team to assist you. We also believe that you need to have your estate planning in order to ensure that your assets are left behind to your loved ones and or charities. Along with that comes insurance planning, whether that's life or health. Along with all of this, obviously comes your investment planning, which you need to have confidence will help you accomplish your goals and objectives. As you can see, there's a number of areas that you need to be taking into consideration when it comes to your retirement planning. We'd love the opportunity to share with you how we approach all of these areas within your retirement plan. Please call the number on your screen.
Today in Chalk Talk, we are talking about standard deviation and exactly how it works. And by the way, as you can tell, I'm clearly not an artist. This is kind of the best I can do. But what I've drawn here is something called a bell curve. And you can kind of see the shape of it here. It's shaped a little bit, you can see right here, shaped like a bell. That's why they call it a bell curve. And in our first segment there, we talked about something called standard deviation, and why is that important? Well, for you to understand why it's important, you need to understand the visual of it, which is called a bell curve, and what's going on. So here is statistically how things work. Now remember, we're talking statistics here, and whenever this whole bell curve concept was designed, it was designed to measure physical things like, how tall are people in the United States, and here's the average and here's how much they vary. But in this case, we're using this concept to measure markets. And so let's imagine you come into our office, you watch the show, you say, oh, I want you guys to run an analysis for my retirement. So you call us, you come on in and visit, which I encourage that you do. And when you come in, we put your portfolio in Morningstar and we learn, oh, look at this. Your portfolio should average about a 6% return. Okay, how's that? 6%, that's the average. This middle line right here is the average return. So let's imagine that's your average. Now the question is, how far away might your returns be from that 6% average? Would you be close to that 6% every year, or might there be a lot of variance? And let's imagine that Morningstar says you have a standard deviation in your portfolio of, and I'll pick an even number, 10%. 10%. So let's say they say your standard deviation is, there it is right there, 10%. Now, is that good or bad? What does that mean to you? Well, here's what it means. Here's what it means. It means that 1, 2, 3, there are 3 standard deviations that measure important points, and here's what they mean. This first level right here, see these 2 levels right here in green, this first level? That represents what's going to happen 67% of the time. So here's what that means to you. 60% of the years, about 2/3 of the time, you would experience a return that is 6% plus or minus 1 standard deviation, or 10. So maybe -4 plus 16. So about 2/3 of the years, you're going to be between -4 and +16, which isn't bad. That's fine. Now, 2 standard deviations away, that's 95% of the time. So what they're saying there is they're saying, okay, 6% plus 2 of these, 20%. So 95% of the years you should be plus 26, minus 6% minus 20, minus 14. That's what that means. And then 3 standard deviations, well, this is 99% of the time. So 99% of the years you should be plus 6% plus 3 standard deviations is 30 plus 36, or minus 24. How's that? Make sense to you? So here is the problem in the financial industry. The financial industry has what is called fat tails, meaning only 1% of the time you should have a return lower than that. In other words, you should go outside of that or above this number. But fat tails means no. In the financial industry, instead of this happening once every 100 years, it happens more like once every 10 years. In other words, we have more risk than we think we do. When I talk about your standard deviation should be no more than 5%. No more than 5, what that really means in this example is if your average return is 6%, your best year should really be more like plus 21, but your worst year, maybe minus 11. That would be more appropriate for retirement planning. Now the question is, which one is you? Where are you? That's why you want to come in and visit with us so you can find out.
When it's time to retire, you've probably worked for 30 or 40 years or more potentially. Have you ever thought about, though, in retirement, that's like 20 to 30 years of unemployment. Where is your paycheck going to come from? How are you going to sustain your lifestyle in retirement? And what is your plan to do that? If you don't have this plan, Centennial Wealth Advisory would love to sit down with you and try to help you walk through those matters, develop a solid income plan, rolled in with a tax plan, and have your estate plan, all cohesively working together so you can live a comfortable retirement.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, August 6th at the Evergreen Resort in Cadillac. Thursday, August 8th at Big Buck Brewery in Gaylord, or Tuesday, August 13th at Stafford's Bay View Inn in Petoskey. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated Financial Decisions. Call 888-608-5825 today.
Welcome back to Retiring Well. Listen, guys, that episode Mike just did on Chalk Talk with standard deviation, I think he did an awesome job of explaining, the range of returns that can happen. What do most mutual funds and companies do? They always put forth their averages, right?
Oh, yeah.
So they always want you to see that, what it's done over time, but what they don't want you to see is what's the variance been, what's the pluses and the minuses, and we've already talked about in earlier segments. If that minus can be big at all, that can be devastating to any income plan. Wouldn't you agree?
Yeah, I mean, that's exactly true. I mean, if you can, an average return can look very favorable for you, and especially recently, if they're just looking at the last 10 years, it can look great. But what they're failing to disclose in that is what is the best and the worst? Hey, maybe it is way better. It could have a better return, but also what could be really, really bad? Now, as a retiree or soon-to-be retiree, that's probably just as important, if not more important, than an average return.
Yeah, and here's the other thing, that people don't recognize. We actually have the tools to get behind any portfolio and actually show them what it did, right? Yeah. How to do, as their position today, how did it operate in 2000 through 2002? How did it do in 2008? I mean, we can actually tell them what that drawdown's been.
Yeah, I mean, I think it's interesting because the folks with taking income, you've been lulled to sleep with these great returns. Are you okay with the worst case scenario? We're usually all okay with the best case scenario. That's fantastic. It shoots way up there. But are you okay if it loses a certain percentage?
Yeah, and I think that's the key, Art, is understanding, it's not just about this average, but those range of returns. And hey, can we, instead of having this big of a variance, hey, can we reduce that, keep the average comparable, but not have as much exposure to risk? So ultimately, we'd love the opportunity to sit down with you for no cost, no obligation, second opinion, and just understand sort of what your standard deviation looks like on your portfolio. So thanks again for tuning in to Retiring Well, and we look forward to seeing you next week.